It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Welcome back to Trading Stocks Made Easy. It's Tyrone Jackson, the wealthy investor. I see you can't get enough of me. Well, guess what? I can't get enough of you. Today's show is about what is going on with television streaming and where the profits are. Now, this might not seem like a big deal to you initially, but at the end of the show, I'm going to give you 4 stocks I think are going to rise significantly that you will want to own at least some of. But first, before I get into this topic, because it's a big one, I have to explain to you what's going on. So here are a couple of things that I'm sure you've noticed, but you may not have realized. There are hundreds of thousands of dollars in this new trend. The trend is called streaming, and it's here to stay. So let me explain to you what's going on in the television business right now. This major, what we call disruption going on. And publicly traded companies are battling each other for a kind of supremacy. So you can get in the middle of this battle if you know which stocks to own. Okay, so we used to watch television. It feels so strange to say that, but we used to watch television from big television networks like ABC, NBC, CBS, and Fox. Those companies actually produce shows or programming, as they say in the television business. They send a signal out across the United States. Local stations, which are known as affiliates, pick up that signal. And then the NBC television network charges advertisers to advertise on their shows during that particular time. This is what's known as broadcasting. So NBC, CBS, ABC, and Fox don't own every station that they send their signal to. The stations that pick up their signal are what's known as affiliates. NBC, CBS, ABC, and Fox pay those affiliates to carry that signal, especially during prime time. So the larger network makes its money off of reach in those stations, and those stations get paid to carry that signal. The stations that are smaller, they sell some of that advertising time. That's how they make money, while simultaneously collecting a fee from the larger network. There are other stations in your town that don't carry the NBC, CBS, or ABC logo, and those stations are independent. They're free to put on the air whatever they want, and they make their money selling time to local advertisers. Now, the anatomy of the television business is not always easy to understand, but I want you to know that if you're in the stock market, there are profits in the system that's being disrupted. Okay? All right. So we've got our network television stations that send out a signal to their affiliates. Their affiliates get paid. And then the network television charges advertisers on the exposure from these TV shows. Now, let's back up here for a second. Most people are not watching TV on a broadcast signal, and if they are, those audience numbers are declining, except in certain circumstances, like the Super Bowl, for example. We're all tuning in to watch the Super Bowl on a broadcast signal or on a cable system, okay? Which is how most people get their broadcast signal these days. But we found, the television industry, has found that people don't watch the Grammys anymore, the Country Music Awards, the Emmys, and the Oscars. It's almost as if the public just doesn't care about that anymore. Okay? So, in short, TV audiences are shrinking, which means less advertising for the big television networks. They're not making as much money. Since the iPhone was invented, people have become accustomed to watching television on a streaming device. Got it? So there's no more signal through the air. That is not as popular as it used to be because most people are used to watching a television show on demand. So When Netflix came along, it was a major disruptor because you were able to watch your favorite television shows in some cases, movies, all of that programming on demand whenever you want to do it. Okay. At that time, the industry didn't realize that Netflix would change television forever because we're only going to move forward from here and not back. So would I recommend Netflix stock? Well, it's very expensive and it's very volatile because it goes up $10, it comes down, it does not pay a dividend. It's in the higher risk category. But before I go too far afield, let me continue to explain the trend to you. There's a saying on Wall Street when you're trading and investing, let the trend be your friend, so you never go against the trend. So Netflix really popularized streaming, and they charge you a monthly fee to watch as many programs as you want. But they are not broadcasting that signal. The programming is actually coming from what? A server. Information on a server. So what is a server? It's basically a very large computer that stores information, data, photographs, and movies and television shows. So who runs the server for Netflix and all of their programming? The answer is Amazon. Amazon is huge in the server business. In fact, they call their server business AWS. Short for Amazon Web Services. But there are a lot more than web services right now. So when you're watching a program on Netflix, you're calling it up off of a server. In order for that picture to never buffer, you remember buffering, right? And to come to you smoothly, there's a lot of technology that goes on in the middle. But imagine 50, 60 million people wanting to watch the show at the same time. You can't run that one show on one server. So in order for Netflix to run smoothly without buffering, it is now on thousands of servers. Thousands of servers, not only across the United States, but in different parts of the world. Why? You're going to need thousands of servers to handle all of that on-demand activity to make that picture flow to you nice and smoothly. Are you starting to smell the billions of dollars? In the Wealthy Investor Program, I call this co-relationships. Sometimes you can get rich or richer owning just 7 stocks that all do business with one another. Well, we have a co-relationship between Amazon AWS and Netflix. So guess what all of the other streaming companies want? They want that non-buffering ease of picture experience, but it's very, very expensive. So let's talk about our good friends over at the Walt Disney Company, who used to get $1.3 billion from Netflix for licensing all of their shows, and they would sit on the Netflix platform. Well, Disney got kind of big and bad and decided, why should we take your check for $3.1 billion? We'll start our own streaming services and we'll keep all of that profit for ourselves. This is what's known in my mind as the great misstep. Because Disney is today we call it a content company, they actually produce entertainment content, right? They're not really that strong when it comes to technology. They didn't take into account the back-end systems and the cost of the back-end systems to have their own streaming services. Therefore, all those movies and TV shows and Marvel products that are under the Disney banner, guess what? They're costing so much money to deliver to you. Disney lost $4.2 billion on streaming last year. But it's too late to back up now because the smarter move would have been to give all of your content to Netflix for $3.1 billion and just suck in the $3.1 billion annually. Therefore, you'd have no cost and your catalog is making money. So Disney's infrastructure cost for all of the servers and to be able to deliver that content to you is overwhelming. They're stuck. So therefore, they had a loss. That's why they cut the dividend on Disney. If you've been listening to the show, I've been talking to you a lot about that. And when you cut that dividend, that stock is going to fall because the banks, insurance companies, and the big buyers who own $10, $15, $20 million in shares, guess what they're going to do? They're going to sell your stock because big banks, insurance companies, they love to collect dividends. When you take that dividend away from them, there goes that guaranteed rate of return. See, this whole financial world, when someone explains it to you, it's pretty marvelous, right? You can almost predict what stocks are going to go up, go down, or stay the same in the next 5 years based on dividends and understanding the trend, or as I often like to call it, the story. Let the trend be your friend, because Disney went against the trend, started their own streaming service. Now they're losing billions of dollars on it. And guess who the most profitable player is in streaming? It is Netflix, with positive cash flow every single quarter. Which stock do you think is going higher? Back in a moment.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
Hey, it's Tyrone Jackson, Wealthy Investor again, and I just wanted to remind you that if you enjoy listening to the Trading Stocks Made Easy podcast, be sure to share it with your friends all across social media, including Facebook, Instagram, and Twitter. If you enjoy hearing about success principles that inspire you, as well as interviews with some of my most successful students, I want to remind you it's right here at the Trading Stocks Made Easy podcast, wherever you get your podcast. And make sure you download as much free material as you want at thewealthyinvestor.net. I'll see you there. And welcome back. Today we're talking about streaming television and big profits. Now we know companies like Disney, as of the time of this recording, is losing money on their streaming services, and Netflix is indeed the winner. Now, we don't talk about this much on this show, but there's something called free cash flow. When a company has top-line revenue growth and good free cash flow, generally speaking, their stock is going to go higher because you got that gross revenue rising, free cash flow. What is that? Well, that's essentially how much money the company actually has in savings on the side. Netflix is proud to boast that their free cash flow will be over $3 billion in a savings account, in essence. And when a company keeps telling you how much free cash flow they have, guess what? That's because they're about to take that cash flow and buy something. What do you think Netflix is going to buy? Well, I actually have an answer for that, but I'll tell you about that a little bit down the road. Okay, so if 88% of what we used to call television shows are now sitting on a server somewhere around the world, usually multiple servers, so that streaming signal can be delivered to you nice and smooth. It doesn't take a genius to suddenly know the company who offers servers for streamings are going to make a lot of money. Now, let me explain to you how these contracts work. So if I want to start a streaming service and I need all my content on a server, digital images and movies take up a lot of space. You can see that on your computer. In fact, your computer could be considered in a very broad sense a server that only you access. Well, the more space taken up on the server, the more the charge for storage. Like I always say when I'm talking about Apple stock, have you ever noticed that Apple stock keeps rising? Right, because their services sector is basically their cloud division. In other words, if you have an Apple account and you have all of your information from your phone and your computer being backed up, that's cloud services, right? And have you ever gotten an alert from Apple that says, hey, you only have half a terabyte left because you're storing so many movies and photographs. We got to charge you a little bit more? Well, if that's ever happened to you, then guess what is happening to Disney and the larger services? The more they store, the larger their bill. So if they start out with a server deal where they're paying $10 million a month for all that space and they keep adding new movies, guess what happens to the $10 million a month? the fee goes up, and the company that owns the server is making more and more top-line revenue. Now, who are the major services in the cloud? Well, get ready, write this down. They are Amazon.com with AWS, Microsoft with their Azure services, IBM, and Google. So in effect, guess who's running the entire entertainment world? He or she who has the servers are the big winners. Why? They're regulating the data. They're making sure that the signals flow. They make sure that there's no corruption on the server, that the whole world can access Black Panther at the same time. They are the big winners. Well, all of these companies are publicly traded. What do you think is going to happen with their stock prices in the next 5 years? I'll tell you right now, they're all going to double. Now, Amazon just came out with their earnings, and where did they see the most growth? In cloud services, of course. Microsoft just released their earnings. The stock jumped $22 on the day the earnings were released. Why? Because they saw a 27% year-over-year growth in the cloud. What does that mean? It means their clients, Pluto TV, Disney, Warner Brothers, Paramount, they're all on their servers. So you see this disruption that's going on, the tech guys are really beating the heck out of the creative guys. So I can only foresee a time where the government's going to get involved and start to deal with regulations because the server fees are going to be ridiculous. And the government is ultimately going to say to those companies, we have to regulate how much you're charging your customers because you're just going to take advantage of everyone. I can actually foresee a day when one of these major server providers are going to buy the content creators because the content creators won't be able to deliver their programming to you and I economically. Why not just sell out? Now, maybe this is 5 or 7 years down the line. But what I see right now is Netflix, with all that free cash flow, is about to buy a streaming provider. Now, this is how it goes, and this is how you know that the wealthy investor approach is indeed credible. I have a saying, which is, on Wall Street, the big fish always eat the little fish. That's called, in investment banking terms, consolidation, right? There are billions of dollars being made with a big company coming in and buying small players because you're getting the revenue from all those companies that you are buying, which is also known as non-organic revenue growth. So the investment bankers are going to win big when bigger companies start buying smaller companies because they take fees on all that consolidation. So when bigger companies start buying smaller companies, right, they sometimes assume more debt and financial responsibility. So what's the easiest way out of that? A stock split. Because a stock split causes the price of a particular company to come down, particularly on a 2-for-1 stock split, so the public can get more shares. So, do you see what's happening for you right now? You're in the middle of a technological revolution, and if you understand what's going on at the top of the food chain, you know which stocks are going to increase because they're going to increase their revenue, and they're going to gobble up some of the major players as well as the smaller players. And ultimately, there'll be 3, maybe 4 players left in the server space. If you and I wanted to start a cloud services company, we can do it. But in order to start up, our servers cost a lot of money. So Amazon says to us, hey, Tyrone and Company, we'll offer you a white label system. It'll look like it's yours, but it's really us, and you can market it as your own. There are billions of dollars about to be made in the stock market off these companies in the cloud, just on the entertainment side alone. Why am I doing today's show just for you? Because it's all part of your financial education. When you understand what's going on in a larger marketplace, you can see stock prices rising and consolidation coming. If you are serious about being successful in the stock market and you don't have a brokerage account, you need to open them right now and start buying shares slowly in these cloud companies because they are the future. We're not just talking about you and I. We're talking about cloud servers that will be serving the entire planet. A lot of money to be made in these stocks. Think about what I've just talked about in today's episode and plan accordingly. Own shares in the companies that dominate the cloud. I'm Tyrone Jackson, the Wealthy Investor. That's my advice for this week. I'll see you next week right here on the Trading Stocks Made Easy podcast.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.